Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the Econ Show, we're going to go through some things a little bit differently. We're going to look at what is happening with global debt, global inflation. What are some of those metrics that we're seeing, and then we're going to take that subset and then go into the U.S. and look at wage either growth or compression. Where are things in the supply chain in general? Then that's going to give way to real estate. Where are we with evictions? Some of the inflation throughout the supply chain, and really what comes next. Are we going to get more inflation, stagflation, deflation? And then we're going to look at European debt more specific. And then as we go into Asia, we want to look at inflation throughout the supply chain, because we keep seeing the PPIs going higher. We keep seeing this pressure. And then more specifically, when we look to China on credit impulses and what are some of the headwinds that we continue to see. So before we get into all that, obviously we'd like to remind you, please like, share, subscribe. Your support is appreciated. When we look at just e-commerce, so one of the interesting things that this was a chart that we had found that we thought was interesting in its own right. E-commerce becoming more prevalent. People have been taking advantage of this given COVID. What is the greenhouse impact? Like, how much are we really saving? And it's interesting when you look at packaging, especially because, I don't know if you've had it where you get an Amazon package and there's a book inside of something that you could fit a refrigerator coming to your door, and you're like, all right, well, what is the efficiency of this? Why is this happening in that way? And they've gotten better, but there is a lot to be said about the plastic, the protection of the items, the movement, and the cardboard. But the interesting one is going to be the transportation, because even if you're not getting anything from online in terms of on a FedEx truck, USPS, UPS truck, it's still passing your house. So when you order stuff, it's just making that more efficient. So it'll be interesting to see how the returns and transport really starts to factor in, because the returns is actually a bigger side of that as well, which I think is going to be some of those interesting impacts. Then when we look at, especially with what the U.S. is going to be spending on, when we look at infrastructure, and unfortunately, some of that money is going to be going to places that it really isn't as needed as it is in the aging infrastructure of America. And one of the things that I've been doing in our private equity fund is really looking at, is there an opportunity to invest in water infrastructure, especially dams on a hydroelectric side, water in terms of getting clean water to your house and wastewater away from your house. These are things that have been ignored or haven't really been invested in a long period of time, and they're starting to fail. And that's where I think there's a lot of opportunity. It's not sexy at all. It's just a matter of it's necessary. It has a very attractive return, especially if you can do things and optimize and introduce some technology, really high grade things, which I think are going to be interesting in general. Now, the last factor that we just wanted to touch on is when we look at the accumulated net U.S. corn export sales in the new marketing year. And here you can see just what is happening. We always get an acceleration of sales. You're just looking at it's happening much sooner than normal, and there's a lot of reasons behind that. So on the China side, so Chinese traders say they're importing a record volume of U.S. feedstocks, including soybeans, corn, and sorghum. Traders also say they're diversifying suppliers on concerns about U.S.-China trade relations. But when you turn to, okay, well, what is Brazil doing? Well, Brazil slashes the total corn crop to 91.1 million tons after reducing the outlook by 15% due to drought. The 2021 corn export forecast was cut by 9 million tons to 26 million tons. And it would be a very consequential for the market. This is coming from Karen on Twitter, and just to give you her handle, just because I think she's fantastic, and I've talked about her before, Karen Braun, who is someone that is always kind of keeping us up to date and doing a good job of it. Now, Thursday's U.S. export sales report which is the week through May 13th, shows some of the big corn sales that we've been seeing, especially from China. So between old and new crop, between 2.7 and 4.9 million tons, metric tons, which is why we're already just seeing this acceleration, which when you look at the feedstock side and the feed coming through, the Minister of Agriculture and Rural Affairs say hog herd expected to recover to pre-African swine fever. So obviously you're going to need more food. You have to support that. Now, the other issue is right now there's a new outbreak of avian flu. Is that going to make its way into the chicken flock? That's going to remain to be seen. But these are things that we're going to be looking at because food inflation continues to be a big driver to why we think the basket in general is going to continue to drift higher, not at the same rate it has previously, but still in an upward trend because of these underlying problems that remain in the system. So now when we turn to the amount of global debt, so we've seen a slowdown in debt in general. So total global debt fell by 1.7 trillion to 289 trillion in Q1, which was the first decline in about 2 years. And if you think about what 2020 was, you had this huge surge in borrowing in order to try to stimulate the economies of the world. So you're just going to have a natural decline off of that. The issue is that the declines are going to be very slow because no country has the ability to pay a lot of this off. So there's just going to be kind of a rolling debt amount. So instead of it being this nice, bigger decline, it's just going to be a kind of a steady state sideways, something similar to what we had after 2018, where you had, essentially really not much happening all the way through. And as you can see, GDP is starting to flatten out. But when we think about just global debt in general, you can get an idea of just the percentage weighting versus GDP, which remains elevated. Now, when we turn a little bit differently and we look at some of the different backdrops and we look at the emerging markets, the 32 bonds till, you can see just the elevated level of non-financial debt and just the financial sectors in general, how much debt remains in the system. And this is all coming at the same time where the Fed minutes just dropped from the Federal Open Meeting. And the comments are, and the reason why this is important when we're looking at emerging markets, because they're essentially saying the economy remains far from committee's goals, will be some time before substantial progress. So on the outlook for asset purchases, the minutes say various participants thought it would be some time before further progress is made on the Fed's objectives. But last time it was just participants noted. Various versus participants suggest it wasn't perhaps unanimous that everybody felt that it would be some time before further substantial progress. So there's they're talking about easing from the U.S. Fed. And then this is all also happening while the Fed's overnight reverse repo facility hit a new high of 43 participants, took $294 billion, which exceeded Tuesday's take-up of $243.5 billion, and it's the highest level since December of 2017. And if you remember where we were in December of 2017, this was right before, again, you had some of this adjustments in when you looked at easing in the U.S., but this is also something that happened aggressively when you think about the 07, 08 and what that is going to entail in general. So essentially, they're talking about, which just means that we're still going to have easing, we're still going to have activity, which is going to keep more dollars flowing into the market overall. And that's where we start to turn to more economies exceeding inflation targets. So when we look at above midpoint in March and April, you can see and not only just above the midpoint, but above the upper limit, you're seeing this move higher in terms of just not only just US, but also in the emerging market land, where you have the US CPI level, US PCE, you're starting to see this inflation push in terms of the latest inflation readings, and then the targeted midpoints. So the target midpoints, and that's why when we look at the overall supply chain, you can't just look at what is the consumer buying right now, which is the basket of CPI. And it's a poor measure of it, always has been, always will be. but you have to look through the supply chain. Where is it getting better? And when you look out fully abroad to the international world where we're pulling down product, is that getting better? Are we seeing more from or less inflation within the producer price index, the PPI, in Japan, in China, in Germany, in South Korea, places that the U.S. is buying product from? And the answer is no. So if you're seeing that going up, and then that you're seeing import prices going up, and you're seeing container rates going up, again, all of these additional costs are going to continue to go through the system. And this is even without a whole lot of wage inflation. So now as wages go up, because you have to try to incentivize people back, that is only going to just be a topper on top of what the increase in prices have already been. So that's why when you think about what is the biggest concern overall, it's inflation. And not to toot my own horn or tout myself, but when I was talking about inflation the beginning of 2020, or I should say April of 2020, when we were coming out or starting to see some of this flatlining of activity and starting to see some increases, I was like, inflation is going to be the biggest problem of 2021 into 2022 and most likely into 23. And I was told I was crazy. And now here we are, where this is the biggest comments, the biggest thing that people are talking about, because you can see it coming through the supply chain. You have companies that are already talking about it. We've had some large, conglomerates talking about the amount of inflation they're seeing, and it's going to get pushed off onto, or as much of it can be, into the consumer. So then when we look at manufacturing PMIs in the Eurozone and US, this is the component of, well, let's look at manufacturing. So Eurozone and US manufacturing have been fairly close with each other, but the services side is the one that has been missing the most. And that's where, as the Eurozone reopens, we'll start to see some of that growth in the on the service PMI side. But we still see some additional headwinds on the manufacturing. So while one starts to go up, we expect to see a little bit of a normalization, but still a net positive for just general activity between Europe and the US. Which is why when we think about inflation surprising to the upside, well, as you have more activity, you're going to start to see some of these price increases in general. So when we look at the globe, G10, emerging markets, the trend has continued to go up, and city inflation surprise index is just showing where people were already expecting inflation, and it's higher than what was expected. And that's why it's important to think about what is the surprise to the inflation side. And yes, it's talked about, transitory. And when we talk about Asia, especially China and credit impulses, so we've dedicated shows to Chinese credit impulses. I've done threads on Twitter about it, where the credit impulses are coming down. So that's going to pull pricing lower, copper, iron ore, steel. Those things will start to come down, but the general supply chain disruptions, it's less about prices really correcting lower and more along the lines of just stop going up. Now, it'll correct, you will see 10% declines, which is going to be a net positive, but not all of those increases up had been pushed to the consumer. So now as they start to come down, that's not going to change the push to the consumer. They're still going to try to recover as much as they can. It's just going to be a matter of, again, is it inflation or stagflation? And I think that especially when you start looking into Asia, you have to consider, what does stagflation look like? And is that going to be a bigger issue versus inflation or deflation at this point in time? But regardless, especially on the emerging market side, I expect to see inflation surprises to the upside. And you'll continue to see this because it's not done. I don't think, especially when you look at at March into April into May. I mean, I've only seen prices go up. So I think we have another quarter or two of just straight inflation, and then we're going to start to see some of this flatlining. And I think you're going to see this backdrop of just stagflation starting to take hold, which is going to be, I think, a bigger problem on the longer term. So then when we look at output prices, this is, I think, the key component when we're looking at manufacturing PMIs. You have to look at what are the prices out there. And here you can see just the output prices going on. And And I'll do another in the last segment. I'm going to do something on chips and tech, and we continue to see these pressures. And it's not just there. Like we can look to Brazil, we can look to Chile, Peru in terms of iron ore and raw materials. You're starting to get some activity back, but again, there's a lot of disruptions. There's a lot of backfilling in the system that has to happen. And there's a lot of cost when you look at the container and the shipping side. So then when you take this and say, okay, well, macro, when you look at the Fed, so the Fed is saying that we're not easing yet. So you look at the Fed funds rate, but yet when you look at jobs hard to fill, we've exploded to the upside, but yet we've seen no increases in the Fed funds rate. So you're telling me that the goals haven't been achieved, but when I look at the hard to fill, the goals are getting closer to, and that's, again, what is the disconnect? Where is the disconnect overall? And given each one of these indicators has their own flaws, and we have done countless times. We've talked about the jobs hard to fill. And what are those issues? When you look at the mismatch of skill sets, when you have the jobs that are available and the people that are available, the skills aren't matching. Some of these these laborers, they don't want to come back because they're getting paid more to stay home. You're getting a lot of these disconnects in the market, which is making that jobs hard to fill. But you're looking at the job side and you're like, all right, well, you're telling me things are getting better, but then you're telling me they're not. But then the market is at, off all-time highs now, but still on a global level near all-time highs. I think since October or November of 2020, the U.S. market has hit a new all-time high every single month. So clearly there's a disconnect, and we can go through inflation and the backdrops of money flows and liquidity, because obviously that's a huge part of it. But these are things that we need to start considering as, when do we get back to a normal market? And that's an unknown. And what are the issues with that? Well, COVID. Like, what is COVID? Where is COVID still impacting us? And Americans' avoidance of some activities persists. And this was, I think, an interesting one, where as of May, percent avoided events with large crowds is still at 60% in terms of, obviously, the Gallup poll of who was actually interviewed. And then avoided public places like stores and restaurants still coming down. But you can see that some of this has kind of flatlined, and avoided travel by plane, bus, subway, train. Both of those things, in terms of avoided large crowds and avoid travel by plane and subway, bus, train, those have flatlined. And that's where, when we look at activity in general, there's going to be a period where consumers are conflicted of, well, I want to get back, but I'm a little nervous. And I think you're going to see some of this stickiness be relatively pervasive through the system, and really slow down some of this activity, which is not just in the U.S. I think this is something that can be said about other areas around the world, which again is going to kind of slow down or limit some of the activities or normalcy that is expected in the market. And what is that doing? When we look at, how are we trying to address that? And I think it's interesting when you look at states ending emergency benefits, because this is a way to, okay, well, let's give people a little bit less money. Obviously, it's not cutting instantly. And to try to incentivize, like, look, it's going to make sense to go back, because some people are saying, you're offering me $17 an hour and I'm making 23 at home. Why? And that's where I think you're starting to see some of this come through. But then and we'll go through this on the wage side, some of these lower income levels have started to come back. And the question is going to be, when this goes away, is it really the lower income levels or the mid income levels? And we have a chart on that, where we've actually had lower wage jobs starting to come back faster, even with the benefits. So I think we're going to have to look at and really address, is this going to be a big mover in terms of bringing additional jobs back? Short answer, yes. I think it will. I think you'll get the people that'll be incentivized to come back. It's just, I don't think it'll be the big pop everybody's hoping for, which is, again, something that we've been talking about. And another big problem that we continue to see is on the eviction side. So when you look at the evictions rate, eviction filing rate, when we look at the eviction rate remaining fairly slow, and when we look at just, some of the issues on the CDC in terms of when is it going to expire. So the eviction rate has been slow, but the eviction filing rate has now become bigger and bigger. And you can see it all along the East Coast, where you're getting the filing rate really starting to increase, with the big circle being Philadelphia. So the question will be, as we get more evictions, as we get more foreclosures, will we see more volume on the market that will help tamper or at least cap some of this inflation that we've seen on the housing side, which we'll talk about more in a little while when we start looking at prices to build and costs. So I think the interesting thing is over half of voters in the U.S. believe that the U.S. economy needs more help. That's a lot given the amount of stimulus that has already come into the market, because at what point is it too much? And that's when you start looking at law of diminishing returns. When are we just saturating the saturated? And I think we're starting to really get to that point here, which is where it's going to be interesting, because, over 50% of voters, all voters in general, think there needs to be more. Clearly not to, even today's Republicans, it's hard to say conservative, fiscal conservatives, but there needs to be something. It just can't be straight checks. It has to be something of, again, infrastructure. As we showed at the very beginning, there's a lot of bridges that need to be built or rebuilt or restructured or repaired. There's a lot of repairs in this country. So let's give people jobs, getting back to construction and doing something that has an economic multiplier impact, versus just here's a check to go, buy Louis Vuitton or Coach or something else. And not to say that everyone's doing that, because they're not. Some people are using that money to buy food, to buy clothing, to buy things that they need. But let's make it long term. Let's give them the money. But who doesn't feel good when they build something or do something or come home from a hard day's work and say, like, look, I earned this and I did something that I can be proud of. And I think that that's going to be those back and forths. Now, when you think about income, and this is why the income is so important, how soon from now would you be comfortable traveling? And when you look at just the backdrop, 50% are saying that I'm comfortable now on the 100,000 and less. But then when you start going out in general, the in 6 or more months is still a bigger chunk than even I would have expected. And again, this speaks to some of the slowdowns and some of the hindrances of when do we start to see some of that normalcy. And then this is just looking at it in a different way. How soon from now would you be comfortable traveling or going on vacation? I would have expected a mixture of I'm comfortable now to 1 to 2 months. The fact that the 6 months is still a pervasive number, I think speaks a little bit less to COVID and more to the income situation, which is some of the back and forth that we continue to see in the overhangs. But then, for how much longer do you expect to have to practice self-isolation? More than 6 months. I was very, it seems like more than 6 months, and I'm not sure. And if you're uncertain about something, you'll always default to the easiest answer of, I'll just wait. And this, again, speaks to some of the overarching problems that I continue to kind of see in the system. And now it's important to understand that there's 339,000 people that responded to this over the last month. And I think that this is going to be how quickly do we see some of that normalcy, which is why when we look at vaccine rollout and vaccine acceptance, you're seeing that slowdown in people willing to get vaccines, which is putting because people that wanted it got it. And that's why I think that there's going to be some of this overhang that the market doesn't appreciate. And then how concerned are you about being in public spaces? It's very concerned, I think makes sense, low, but the somewhat concerned is, and not concerned at all, but the somewhat concerned has actually increased. And I think it's because as people see them more, they're like, I'm not ready for that. Like after seeing it, and I've had this conversation with my wife, she was like, I'm okay with it. I'd like to go out. And then she saw it and she essentially said to me, it's like, I'm still not ready. And and I've tried to pull her out of that shell a bit, but I think there's more of that, especially where it's like, it sounds good, it sounds exciting because you want to get back to normal, and then you see it and you're like, maybe in another month. And I think you're going to have to start to see people slowly get into it. I think once they get into it, there's an acceleration through it. But again, that comfort level will take time to start to kind of come through. And now in the next segment, we're going to go through a bit more about what is happening within the U.S. in terms of stimulus and movements, because I think this is going to be important for not only just where are we in the inflation cycle, but also where are we in wages, and how is that going to impact some of these inflation numbers in general.